Investors Chronicle.
Well, hello, one and all, and welcome to this week's IC Companies and Markets podcast. I'm Mark Robinson, standing in for Dan Jones, who's somewhere in the south of France as we speak, so I believe. And in a packed week, we'll be speaking to some of my colleagues, Jemma Slingo, Dave Baxter, and over the line from Edinburgh, we have Chris Akers. A few things happening this week. We'll talk to Dave shortly about piece he's written about activist investors in the fund space. We'll also be talking to Jemma about a piece that she's cobbled together looking at how AI is affecting media companies and some of the implications in the sector there. And we have our usual result of the week, which Chris has written, and it's about pets at home, one of the darlings of the pandemic era, seeing how they're going at the moment. Firstly, we'll go over a couple of news stories that you're probably well aware of already, but Saudi Arabia is preparing to formally launch a secondary offering of shares in Aramco. It's being pitched at about $10 billion, but I've read somewhere else that it could be as high as 15, which would either way would rank among the largest of its kind in recent times. What this says about Saudi public finances is difficult to gauge, but it probably won't be the last of its offering. I mean, and it's has already attracted great institutional interest there, predictably. Also, we had mining giant BHP that pulled out of their planned takeover of rival Anglo-American. That would have been valued at about £38 billion, that deal. It comes as South Africa they've exited the polls at the moment. And there's an outside chance, from what we hear, that the ANC will lose its ruling majority for the first time since independence, effectively. What that means politically and by extension through to the mining industry is difficult to consider at this point. But they may have to take on some bedfellows in a constitution that might be inimical to the interests of miners in South Africa. We'll see on that one. BHP, of course, have been particularly attracted to Anglo's copper assets, but that political element surrounding the deal would have contributed to the collapse of the discussions. Anglo rejected BHP's calls to extend talks, while BHP said it denied access to key information from Anglo during the negotiations, despite numerous requests, apparently. Elsewhere, Toyota, as part of a joint strategy briefing with Mazda and Subaru, said it will continue research and development of petrol-powered engines, despite the gradual shift in favour of global EV manufacture, although that's actually slowed up to a certain degree in Europe and to a large degree in the US. So it's pretty hard to think there won't be some changes to that timetable over time, but we'll wait on that one. And lastly, Royal Mail owner International Distribution Services has agreed to a takeover at long last worth about £3.6 billion with Czech billionaire Daniel Kretinsky. So I know, Jemma, you've looked at this deal in the past. What are some of the implications there, and will it be a smooth deal, or will there be sort of some regulatory hurdles that we have to take on board?
I doubt it will be smooth. So it's been rumbling on for a little while now. So the first approach was made in April and IDS said, no, we're not interested. It's too low. And then, they've been warming up a bit. And finally, we've had this 370p a share deal, which the board is enthusiastic about and is recommending to shareholders. And it does represent a very sizable premium, and I'm sure anyone who's held IDS for a while will know that the shares have not been performing very well. So from an investor perspective, it looks pretty attractive, but I think from a government perspective, there are likely to be a lot of regulatory hurdles that have to be overcome, and it's sort of made even more confusing by the fact we're in the run-up to an election, so it's not entirely clear who will actually be sort of instigating those investigations, I suppose. So it'll be an interesting time.
Yeah, I mean, could we eventually see a breakup of the group itself? Surely that would sort of grind up against the labour unions, if nothing else?
Well, for now, there's been sort of a variety of safeguards announced at the same time as sort of the deal was announced, and it seems that the group is going to be held together for at least a period after an acquisition if it does happen. But I think it's long been felt that there's this stark discrepancy between the two sides of the business. So you've got the Royal Mail side, which is languishing at best, and then you've got GLS, which is this European courier, which is actually pretty dynamic and doing pretty well. So you can see where the attractive assets lie, I think.
Well, yeah, I mean, I think Royal Mail has always been hamstrung ever since the privatisation as well, because they have that sort of standard obligation to deliver mail on a daily basis and at set prices too. So that's something that may have to be overcome going forward. We may have had to address that even if the takeover offer never went through. So that's one for the back burner. More activity there, no doubt. Now we'll just move on to the first article this week. It's a piece put together by Dave Baxter. And Dave, I mean, this article is inspired in part by Elliott Investment Management that cut its stake in Scottish Mortgage below 5%. But you must have been aware of this phenomenon for some time now.
Yeah, so, I mean, for a long time, you've had activists, or perhaps they might be seen as kind of value-minded investors on the shareholder registers of investment trusts. You have names like City of London, have quite a big presence in the space. But what's been interesting in the last 12 months or so is because the share price discounts to portfolio net asset value have been so wide and trusts have looked very cheap, you've had lots of activists kind of piling into the space. So names like Saba Capital have kind of taken really big stakes. So it's become much more of an issue and kind of a bigger thing for investors to consider right now.
So in a sense, it was because those discounts are on offer as well. Because very often times when I think of activist investors, I tend to think of people coming in and agitating within the market to try and get some action on the share price as well. I mean, it's an open, very often the language is very different that they tend to use of these things, that it's somehow aiming for reforms that a given company may need, for instance. But I think that's oftentimes, call me a cynic, that's a bit of a smokescreen, because it does, for my mind anyway, just come down to sort of value in the marketplace. You said as well, that activist investors are not always a helpful presence, but what's the other side of the equation as well? Can they actually prove advantageous where other investors in a given trust are concerned? I mean, can it help performance?
Definitely can, yeah. I mean, as you mentioned, they can be seen perhaps as an unhelpful presence, predatory, and they can cause a lot of disruption. However, they can also spur lots of positive changes. So, with Scottish Mortgage, people wondered whether there was knowledge of this activist investor coming in, and that prompted, some people wonder whether that prompted the trust to carry out this huge share buyback that, at least for a time, kind of helps to draw the discount in. So you can have things like kind of share buybacks being encouraged, which is kind of accretive to returns. You can have pressure on the board or the investment team to turn things around or review how they're operating. And to give one example, which also involves Elliott Investment Management, about a decade ago, they were a prominent investor on Alliance Trust. And Alliance Trust was kind of struggling, not really kind of delivering the goods in terms of performance. They had this really, really bruising, quite nasty tussle, which resulted in changes at the board, and then also resulted in changes in how the portfolios run. But that's actually been a huge positive story, because now performance is very good and things are working well. And you can also just get, things like trusts offering lower fees and kind of, changing the way they manage things. So it can definitely be a positive and a potential catalyst for better returns in future.
Are there any particular sectors or corners of the investment market that are being targeted? Yeah,
so I think it's probably fair to say that these activists and kind of value investors are pretty rife in the sector, so they are all over. But having said that, a couple of areas that analysts have pointed to are, well, firstly, you have kind of emerging markets and Asian equity trusts. So names like kind of Asia Dragon, Templeton Emerging Markets, Fidelity Emerging Markets, they all have kind of a reasonably chunky level of kind of activist or, value, I suppose, presence on the shareholder register. And then if you want to kind of cut it slightly differently, Baillie Gifford, that's the investment manager with a big kind of growth focus, often focused on areas like tech and so on. They've been hit really hard with interest rates rising, and performance has been pretty poor until recently. So you've seen, they run a huge number of investment trusts, and you've seen quite a few of their trusts now showing up as names where activist investors are pretty present. So to name a couple, Keystone Positive Change, the sort of Baillie Gifford ESG portfolio, has lots of activists at the minute. And Baillie Gifford European Growth is another one as well.
Yeah, it's interesting you mentioned the subject of interest rates as well, because that's obviously has weighed really heavily on emerging markets, for instance, and that's a narrative we pointed out in the past. But because we've had these delays from central banks, and in the case of US interest rates, that any reduction might be pushed back until the second half of the year. But that's certainly, in terms of our readership, something that they should be looking at, because once that general assumption takes hold in the market, then those emerging market indices should start to improve a little bit. But listen, that's it, Dave. Thank you very much. It's an interesting point in the market there. I take a wholly cynical view of these activist investors, but that's just me, really.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
Moving along now, we've got another piece here by Jemma Slingo, and she's been looking at the media sector, or specifically how artificial intelligence deals will affect that going forward. It highlights how generative AI has unsettled the media sector. And it's the week as well that NASDAQ hit a record high, largely down to the clamour over AI too. Jemma, in the article, you quote Nigel Newton as chief executive of Bloomsbury Publishing as saying that it was like the Wild West out there. What do you think he meant by that?
So he was referring to the fact that certain tech companies, often the very, very large ones, are using copyrighted material basically to train their algorithms. And there's this general fear among artists, authors, musicians, magazines, that work is basically going to be copied or reproduced or imitated without payment. So, at the most extreme end of the spectrum, people have basically been likening it to theft, because you should be paying for this content, and at the moment a lot of companies aren't. So we've seen probably some of the most high-profile cases are actors losing their voices to tech companies, and there's this growing issue in the music sector where sort of companies are scraping different tracks and basically generating something that sounds extremely similar, but it's been made by a computer rather than an actual person.
Well, that was the business last week, wasn't it? Scarlett Johansson. I think she complained about this too. I mean, looking as an outsider on this as well, it seems to me you always tend to get these shortfalls in regulation when you've got fast developing new technology as well. It's very rare that the regulatory framework can keep up with that. We've seen this with the drone industry as well. Only now are governments actually starting to come together to get some universal treatment in that regard. Why are some media companies considering alliance with AI specialists in this space?
I think it probably relates to that lack of regulation at the moment and the fear that, well, if companies are just going to be taking our content, we might as well get paid for it. So I would say some companies are going down a completely different route and pursuing litigation. So you've got the New York Times going after Microsoft and OpenAI, accusing them of copyright infringement. So that's one end of the spectrum. But then you also, at the same time, have publishers basically striking content licensing deals with companies, which allows either some access or full access to their archives and their content in exchange for a fee. So it's I don't know, it feels like a landscape that's still very unsettled at the moment, and different companies in the sector are taking a very different approach.
Yeah, I mean, I think there's a danger, looking at the article itself, that the media companies might almost give up their IP by default just because of the nature of the technology itself. It's very difficult. And plus, there must be tremendous legal complexities as well over intellectual property.
Yeah, I mean, there's a lot of fear around it, I think. So if you think about the relationship between sort of traditional media companies and tech over the years, it hasn't exactly been harmonious. And there's this unease that maybe the deals will have unintended consequences. So they might end up sort of cannibalizing revenue streams by surrendering content to the tech companies, or it might sort of inhibit media companies' ability to build their own sort of AI tools. And I think generally the fears are intensified by the fact there just isn't a lot of information out there. So you get these little paragraphs saying, oh, we've got this game-changing deal, but the actual detail is extremely scarce. So from an outsider perspective, it's hard to work out at all what the ins and outs of the deal sort of consist of.
Yeah, it's interesting. There was obviously some value destruction when music became digital. I mean, almost overnight, there were serious issues to do with copyright there, and I guess this is just playing out in another way here, and in a more advanced technological landscape too. So anyway, that's very interesting. Are there any implications for investors, or is it too early to?
Well, I think in some way, I mean, we've covered a lot of the negative territory, but I was chatting to some analysts and they were saying, this is an interesting new revenue stream for either a newspaper publisher or, a magazine publisher, in the sense that you get this nice little windfall by allowing a little bit of access to content. And then there's the prospect that you might be getting recurring revenues over the years if if the relationship works. And it's on a very high margin basis because, from a publisher's perspective, they're not having to do any extra work for that arrangement to be in place. So it might not be all doom and gloom. I just think it feels a little bit, nobody quite trusts the other side yet, I think.
Yep, it's certainly going to be the shape of things to come as well. Even people that I know are accessing it, making their own artworks, recording music. But as you say, it's taking original content and then just reboxing it in many cases. But anyway, Jemma, thank you very much for that. We'll just move rapidly on now to our result of the week, which concerns pets at home. It was, as I say, it was a darling during the pandemic, one of the stocks that benefited hugely from all the social change and social isolation that we saw over that period too. So Chris covered this week's results. What were your general impressions there, Chris?
Yeah, so I think Pets at Home's results highlight the consumer demand for pets and pet products actually is remaining pretty strong, even after that surge during the pandemic. So the company's annual results were pretty much as expected. Revenue ticked up 5%, underlying profits down slightly, down 3%. Had quite a close look at margins. So gross margins were down across both the divisions. So fell across both retail and the vet units. The overall margin was down to just under 47%, hit by a couple of factors. So foods grew faster than accessories, and foreign exchange also had a negative impact on margins. Interestingly, company flagged quite a tough start to the new financial year. Retail sales down by 2% in the first 6 weeks. But I think we have to remember last year had a very tough comparative boosted by pretty high food inflation. So that's not really a big surprise. And investors will be pleased with a new 25 million share buyback as well. So results as expected with some positive signs.
Oh, that's good. It's not the only thing they've got to worry about, their financial performance at the moment, is it? I think the regulator, or one of the regulating bodies, is looking into the industry as a whole, is it not?
Yeah, absolutely. So the CMA has been looking into the UK vet sector, started looking into this the end of last year with concerns around competition in the sector and consumers being poorly served. And it said last week it's going ahead with a full investigation into the sector, which has obviously created some uncertainty for Pets at Home investors. But in our view, we think the company isn't actually exposed to any serious consequences from this. When we think about what the actual potential CMA outcomes could be, we're not that concerned. And obviously, the fact as well that the retail side of the business is the key for profits anyway. Had a look at what analysts are saying on this, and they're generally confident too about any impacts from the CMA probe. Liberum, for example, thinks the probe will have a limited impact on the company. So it's not a surprise that the market's a bit concerned about this, but I think when you look at the detail, we think nothing serious will actually happen.
Oh, I see. So just looking at it overall, then you said there seems to have been not undue margin pressure. The CMA inquiry doesn't seem that it'll have a marked effect on the group itself. So with that in mind, what's the valuation story at the present time?
Yeah, so the shares are trading at about 13 times forward consensus earnings, which is notably cheap when you look at the wider range of UK retail peers. It's about a 10 to 15% discount against those peers, which we think looks quite attractive given trading and other factors. And the valuation is a key reason we remain bullish on the company, as I wrote about this week.
Okay, Chris, that's fantastic. Thank you very much for that. And it's still, we just generally got a favourable outlook with Pets at Home. We have had some time now. Beyond the articles that we've covered so far, excuse me, in this week's magazine, there's some commentary from Hermione Taylor looking at some economic issues, particularly in view of the upcoming general election too. It's interesting that, according to Bowmore Asset Management, the FTSE All Share has grown by an annualised average of 4.9% under Conservative administrations since '83. That compares with an increase of 3.9% under Labour governments too. The Shadow Chancellor, Rachel Reeves, has spent an awful lot of time wooing the city of late with a varying degree of success by all accounts. But I'm tempted to recall Sir John Templeton's warning that the four most dangerous words in investing are "this time it's different," but we will see in due course. And for those given over to Fibonacci numbers and Elliott waves, there's another cover. Well, there's this week's cover feature rather, which has been put together by Alex Newman. It looks at the predictive power of charts, examining, among other things, if there's any common ground between technicians and value investors. I won't spoil the conclusion for you, but it does feature some illuminating commentary from the IC's own Simon Thompson. That's it for this week. Happily, Dan will be back to restore sanity in a few days. So all that needs to be done is to thank Dave, Jemma and Chris for their inputs today, and Madeline Apthorpe, which I failed to mention in the introduction, for all her patience. And finally, to wish all our IC readers and listeners Godspeed and the best of British luck for your investments over the coming week.